makers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Trump's tariffs and taxes dominating the news agenda. We'll have team coverage of trade deals and the so-called Big Beautiful Bill. We'll find out what markets make of it all with the BlackRock's Alex Brazier. But first, the latest on trade. U.S. Commerce Secretary Howard Lutnick says Washington and China have finalized the trade truce. Well, the deal sets out terms from earlier talks, but still depends on future actions.
So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago.
Well, that was Howard Lutnick speaking to Bloomberg yesterday. We're now joined by Ross Matheson, our EMEA news director, and Oliver Crook, our Europe correspondent for The View from Brussels. So thank you both for joining us. Ross, what do we know about the China deal?
Well, it's basically the deal that you can call it a deal or maybe more a framework, an understanding, an MOU, but it's what was agreed to in Geneva. We had confirmation a short time ago from China that they have indeed signed this framework understanding, confirming what we heard, obviously, from Lutnick overnight. But again, it's the broad framework. So it's about the China agreeing to send rare earths into the US easing off a little bit on things like ethane. We know that ethane's actually being shipped but not allowed to yet disembark in China. But China wanted that because they want to keep up their production of things like jet engines. So we've got the broad framework of that, but a lot of the tough stuff, as we know, was not discussed in this understanding and has been pushed down the road, be it all the things that flow into the relationship as well around fentanyl and so on. And so it's an initial framework. Perhaps it's a sentiment moment for markets and shows at least the relationship being on a bit more of an even keel. But as we know with the US and China, things can shift very quickly. So we have a deal, we've had these before, and then things have fallen apart within a matter of months. So it really depends on actually tangibly seeing the US and China now do what they've said they've agreed to do as part of this. That becomes the basis for further talks.
Ollie, on the European side, so EU leaders currently meeting in Brussels, what are they saying about US trade negotiations?
Yeah, Francine, if we have a sort of idea of what the framework looks like with China, we have basically no idea what the framework looks like at the European level between the trade deal between the U.S. and the EU, which is pretty concerning given that the deadline that the Trump administration has imposed is about a week and a half away, July the 9th, and that is the date that theoretically Trump will impose 50% tariffs on that $1 trillion trading relationship between the EU and the United States. The conversation around the table here in Brussels among the member state leaders that gathered yesterday to meet right after that NATO meeting was basically how much asymmetry in this trade relationship are they willing to accept. They do believe that it's going to be unbalanced. They do believe that what the United States is asking for is unfair, but there's a question about how pragmatic they want to be and trying to gauge what Trump's appetite is for escalation. So I'll just quote to you from the new Chancellor of Germany, Friedrich Merz. This was his first EU leaders meeting here in Brussels. He says it's better to go fast and simple than slow and highly complicated. We need to reach a result quickly. We've all agreed to that. There is no disagreement there at all. We've also heard similar things from our reporting from Giorgia Meloni in Italy. Macron has been a little bit more reticent to sign on to this because he doesn't believe, and everybody's playing Trump psychology, that if you give in to everything to Donald Trump, that actually will make the Europeans weaker longer term in negotiations. So I suspect what may happen is in the next week and a half, you potentially get some kind of framework, but you're not going to get that final trade deal. I wouldn't be surprised if it's going to require a flight from Brussels to Washington, D.C. on the part of Ursula von der Leyen to talk directly with the Trump administration, because at this point, any sort of the details of that trade negotiation are still pretty abstract.
And finally, Roz, what do we know about this revenge tax?
Well, that's right. So there had been a lot of talk about the US imposing a revenge tax. This is the US wanting to take ownership of their tax structure, the feeling that they've ceded too much, for example, to the OECD over the years, and threatening, what they said was countries that had discriminatory taxes on US companies. The concern was, in turn, you're going to deter companies, obviously, from investing in the US as a result of putting production in there, which is what Donald Trump actually wants, his companies bringing production to America. We can see the market reaction telling us that perhaps people didn't really seriously think this was going to happen. It was also flagged as sort of a slow death of this in a way of 899, because you can see in recent weeks the G7 saying we're here, let's agree on this. And so not entirely unexpected, but it does obviously provide some sense of relief potentially for companies who are looking at the US.
Thank you both for joining us. There is a lot going on and beautifully put together. Ross Matheson, our EMEA News Director, and Ollie Crook in Brussels. Now we're joined by Alex Brazier, Global Head of Investment and Portfolio Solutions at BlackRock. Alex, there's just a lot to unpack, and it does feel like the financial system just continues to change. And it's unclear where we end up, either on the beautiful bill or things with taxation. So how do you construct a portfolio given all the uncertainties?
I think there's two really big things going on underlying all this. The first is that the stock-bond correlation now is much less reliable than it used to be, sometimes unhelpful, much more positive. And that's because we're in a world of looser fiscal policy. You alluded to the one big beautiful bill. We're in a world of trade restrictions, which means openness declining. It means more upside inflation shocks. We'll see more of that in the US over coming months. For both those reasons, bonds are just a less reliable hedge for stocks. And as a result, portfolios are shifting both from sort of 60-40 to be more 50-30-20 as you get more private markets and the investable universe expands. That's great for diversification too. But also within the public market sleeve, people looking much more now at strategies that are market neutral, uncorrelated with the broader market, uncorrelated with broad factors, and actually looking to exploit the relative value trades that are emerging in this period of structural upheaval.
And would this be basically the private market also component? Because you also, I mean, correlations have broken down, right? If you look at over the last 3-4 months, the way equities and bonds have been doing, you kind of had to always take a double take because they were pulled by different forces.
That's right. And I mean, at any point in time, the correlation is surprising right now for different reasons. But I think two things are going on, right? So one is put in private markets. The investable universe has expanded, and those asset classes in private markets are typically less well correlated with public markets. So that actually acts to diversify the portfolio, move the kind of risk-reward trade-off back closer to where it used to be in the good old days. And then within the public market sleeve, to look to these strategies that are more market neutral at the same time.
Okay, I like the 50-30-20. How much do you worry about a debt crisis or actually a U.S. auction going badly?
We've seen a few kind of flare-ups of that over recent months. I think the US fiscal position is a big story. We're not in a position where the primary deficit is going to be closed. As the bill passes through the Senate right now, we're seeing how difficult it is to get all of the spending cuts that were penciled in by the House. And actually, that means that over the long term, we expect more upward pressure on the long end of US yields. Much prefer the belly of the curve because there are signs that the US economy is slowing. It's pretty resilient, but it's not immune to what's going on. And actually that means we will get some Fed rate cuts this year. The belly of the curve looks reasonably attractive to us. We expect it to steepen over the long term. But I would also add that within fixed income, there are relative value opportunities looking to Europe. Because the other thing that's happening in portfolios is investors, particularly in Europe, are beginning to shift capital away from the US to Europe. We've seen the implications of that in the dollar. We've seen it in exchange-traded flows. And when we survey investors, they're still looking at repatriating capital towards Europe. Same is also true of US investors who are beginning to see more opportunities in Europe.
But Alex, when you look at the Fed, I mean, there has been a little bit of a repricing in cuts, also because there were rumors that Donald Trump would, nominate someone who would effectively be a shadow Fed chair from September, October, and we know how he stands. So it's, it's unclear, I think, what the market is really looking at.
Well, I think this story's been bubbling around for quite a while, but I think it's a reflection of two really underlying forces. The first is that we're now in an environment where stock-bond correlation is less reliable, more inflation shocks, and that means the central bank's facing more occasions when it's facing a difficult trade-off between how quickly you return inflation to target and what kind of economic pain you're willing to tolerate. And that's something that politicians want to have much more of a say in. So it's a different world. And secondly, we're in an environment of looser fiscal positions, and that means typically you prefer lower interest rates. Now, regardless of how that plays out with personalities, it means we're in a regime now of more inflation uncertainty. Inflation will be, positively surprising more often than not, and it'll be brought back slower than perhaps it used to. It's a very different environment, and that means, again, reinforces not liking the long end, and it reinforces reworking portfolios to be much more diversified.
Is stagflation a real risk?
I think when we talk about stagflation, everyone immediately thinks of the 70s. I think what we're talking about here is inflation going up a bit and being generally a bit higher in this fiscally loose and less open global trade environment, and growth being a bit weaker. So we're not talking about sort of 1970s stagflation, but we're just talking about those two things going in opposite directions.
But that would make it very hard for central banks. Is there a scenario where actually central banks just can't get to grips with some of the scenarios that are thrown at them?
No, I think actually it's a question of how quickly they seek to deal with inflation shocks. Do they, when inflation rises, immediately declare it to be transitory, one-off, no need to respond? Or do they take perhaps a tougher stance and react to things that should ultimately be transitory, but they want to bring it back quicker? And I think we're probably less in that latter camp and more in the slightly more tolerant camp. Inflation will ultimately come back, but actually it means that on average you're looking at 3% inflation rather than 1%.
But there's also this mismatch between what surveys and what people think that the economy will do and what's showing up in the data. Is this a mismatch that, is it like a lagging 3-4 months delay, or it could also not come true?
I think it's two things. And we saw initially around Liberation Day, very sharp falls in some of the softer surveys, and the hard data hadn't moved. Now the soft surveys have recovered quite a lot, but the hard data have started to slow, and we think we are seeing in some of our high-frequency, kind of systematic big data signals, more signs of slowing in the labour market, some easing of pay growth. And you look at H1 as a whole, the US economy has grown at a quarterly annualised rate about 0.7%. It's not bad, but it's nothing to write home about. And if that carries on through the year, that's an environment where the US economy has slowed under the weight of uncertainty.
Alex, how do I think about AI transformation and, again, how that filters through your asset allocation?
Yeah, I think two things. The first is that as far as the mega caps go, they've had a great run as, DeepSeek came along in January, but it then became clear that the capex plans of these firms were still very strong and the earnings potential of these firms still very strong. But I think the second point is more important, which is that this trade likely to broaden out over time into who is able to harness AI and adopt AI to really increase productivity. And this is where getting to grips with big data signals of really which companies are able to get to grips with this, raise productivity, boost earnings, who are going to be the winners, who are going to be the losers. And I would say it's proved more valuable recently to be able to get ahead of thematic rotations in the market. On our calculations, about 3 times more valuable than it used to be. So we're seeing much more interest within equity sleeves of these kind of rotational strategies that are trying to get ahead of these rotations in the market around these themes.
But is it too soon to say? Because you don't even know who the winners... I mean, do you have a clear print, actually, of the kind of transformation that we could see AI, that you can start making calls on who will do it
No, and that's why I think it's got to be very precise, very company-level insight, and it's going to take a lot of data to do this. We're finding that the number of signals you need to get ahead of these rotations has gone from kind of 40 years ago to about 1,000 now, right? Now, the data sets have expanded and the technology's expanded to do it, but in this systematic analysis, you've got to get really, really granular.
Okay, your most contrarian call, given it's Friday and we're all looking at the Bezos wedding.
And you don't want me to talk about the Bezos wedding. You don't want me to take on the Bezos wedding. I think actually not quite liking, but everyone likes bunds right now. Actually, given the scale of the fiscal expansion in Germany, even with some repatriation of capital that's going on back across the Atlantic towards Europe, actually bunds don't look that attractive. There are opportunities. We like gilts, not so much bunds right now. And don't stay away from the US long end.
Okay, so good. Thank you so much. We'll talk about Bezos afterwards. Alex Brazier, Global Head of Investment and Portfolio Solutions at BlackRock. Now, coming up, has Nike just done it? See what we did there? We'll dig into the sportswear giant's earnings rebound as shares soar pre-market. That's next, and this is Bloomberg. Welcome back, everyone. Nike shares surging pre-market thanks to a brighter outlook on hints that Chief Executive Elliott Hill's turnaround plan is starting to work. Now, sales still expected to dip this quarter, but less than anticipated. We're joined by Sonia Wind, our consumer reporter. Sonia, thank you for joining us. So is this really the start of a turnaround?
it could be the start of a turnaround, I would say. I mean, it's clear that the quarter was painful. It was one of Nike's worst performances in recent years in terms of the quarters, but it was better than Wall Street has feared. So that also explains the stock reaction. And the CEO said that the worst may be over now and that his new strategy is starting to improve the performance of Nike in the coming quarters. What he's doing is to basically undo the missteps of his predecessor. So that includes improving the relationship to wholesale partners again, because Nike's direct-to-consumer strategy backfired and it lost some market share and shelf space to rivals like On and Hoka. And he's also clearing out excess inventory to make space for fresher and new designs. In addition, he's also doing some partnerships like the one with Kim Kardashian that could also help bring shoppers back to the brand. So it looks like we could be at the start of the turnaround, but of course we have to see like how that's going to continue and whether these changes are taking a hold in the coming quarters.
So, Sonia, what about the potential impact of tariffs?
Yeah, so that's definitely a big challenge, not only for Nike, for many sports retailers. Nike has said that it expects a $1 billion headwind in terms of costs in the fiscal year of 2026. So his strategy is to reallocate the production away from China to other countries. Nike currently produces around 16% of its US footwear in China, and it plans to bring that down over the coming quarters to like a high single-digit percentage rate. So it also looks at how to save costs on the corporate side of things and to what extent it can pass on some costs to consumers, which is always a bit of a tricky balance to strike. But the main priority remains to reignite brand momentum. So he's trying to do that with a renewed focus on core sports areas, especially running. And we've also seen some good early signs for new running shoes, which have seen a warm reception. And upcoming launches like the Air Max Phenomena has seen some online buzz going on. So if that energy also translates into sales, that would of course also help to cushion the impact of tariffs a little bit.
Sonia, thank you so much. Sonia Wynn there with the very latest on Nike. Now, it's been another bad week for the dollar. It slumped on reports that President Trump is considering naming Fed Chair Jay Powell's successor before his term ends. Now, traders took that as a sign that interest rates could be cut sooner than expected. Now, we're joined by Fiotakis, Global Head of FX Strategy and Emerging Markets Macro Strategy at Barclays. Themos, as always, thank you so much for joining us. There's just a lot going on, and dollar kind of underpins everything. What's your dollar call?
We're generally thinking that there may be still a little bit of dollar downside in the near term and maybe some dollar recovery 12 months out, basically.
So what's your, overall, would you play the dollar against?
I think if indeed we are in a place where money's flowing out of the U.S. and into other locations for diversification, emerging markets probably stand to win the most. They offer carry, they offer a better growth momentum, and they also are small enough for these flows to have an enormous impact. And they're now cheap relative to things like the euro.
I like your, the insights that you send around. And there's one, dollar hedging, a trend or a fade. It just feels like it just nails the main question. Which one is it?
Well, first of all, it is the main question because this is a flow-driven market, right? Yeah. You have seen narratives come and go, 899, fiscal, U.S. growth story, and the dollar just keeps selling regardless of the news, right? So it's pretty clearly a flow story. I would say that based on our analysis, you can definitely see under macro scenarios hedging flows taking euro-dollar to something like 120 or slightly above. And that's the upshot of 3 models that we've deployed around this. However, I'd like to say that the higher we go from here, the risk-reward worsens. A, because it becomes a very flow-driven thing, momentum, flows drive flows, which is always a risky location to be. Yeah. And B, because a lot of this hedging is not true hedging in the sense that people are not returning money to their local currency. Right. They're just buying the euro, which is adding to risk as opposed to reducing risks.
So interesting. What's your trade outlook? We started the show talking about, U.S.-China, but also the EU response to what the U.S. is doing.
I think that we are in a period of time where people want to reduce tensions as opposed to build up. So generally speaking, we don't expect to return to a kind of a flare-up like the one we have in April. Okay. However, particularly because of tariffs, but also because of the enormous front-loading that has occurred before tariffs. Trade is likely to slow in the months ahead, basically, right? And that should have its own effects on economies.
When you look, I mean, look, there's a number of questions whether it be stagflation or actually whether there's going to be a shadow Fed chair, which frankly has moved the markets even before confirmation or denial of that. How does that, feed into your narrative?
I think it anchors people's Fed expectations. Even if you get better data, people will always refer to next year as the point of time of chair change. That is going to stay in place for some time. Having said that, Senate will also ultimately need to confirm that person. And that probably leads you to someone who's a little bit more standard, sort of like candidate with Fed background, as opposed to someone who's a multi-standard deviation kind of a candidate, which should be good ultimately.
I quite like that. More of a standard than a multi-standard deviation kind of guy. I mean, I think that's like the new coined phrase. Themos, how do you look at euro?
Euro at the moment is very expensive. If you look at the broad trade-weighted euro, it's the highest it's been in history, basically, right? And this is because a lot of emerging markets have cheapened against that. Euro-dollar doesn't paint the full picture. Euro crosses have risen a lot. This is because it has benefited as the anti-dollar from all these hedging flows. No. For now, it's the only game in town, but the higher we go, the risk-reward is less good. What we have recommended is selling the euro against a multitude of currencies in emerging markets, in majors, carry, and so on and so forth.
But does Europe have an inflation problem to the downside?
Yes, to the downside. I think tariffs will probably add to that.
Okay, so there's a little bit different to actually what we're seeing in the UK. I don't know whether there's a bit more stability in the UK or whether, again, it's a small open economy, anything could happen.
Relative to expectations, I think the UK has proven to be a lot more stable. I cannot think of any other obsession in markets that has lasted for so long than people trying to see or wait to see the UK economy roll over. And the UK economy keeps printing decently. Not great, but decently relative to expectations.
Which means that but this is because of stability or because of just the way that the capital market structure is put in place, or what the Bank of England has done?
Also the fact, all of these things that you mentioned, but also the fact that the shock that you've had to the UK has been a supply shock as opposed to a demand shock, basically, right? Which has kept certain sectors artificially sort of like stimulated in terms of wages, which is what Hugh Pill has also spoken about, right? The stickiness of wages, which has, again, fed back into the Bank of England and the price outlook, etc.
So I don't know what to do with renminbi, but because it's a U.S.-China trade kind of day...
Join the long queue.
It's unsure, right? I mean, it could go either way.
I think one just needs to look at Euro-China. Main trading partner trading at many multi-year highs, basically, right? Either the renminbi at the moment is too cheap or the euro is too expensive. But these things cannot be going apart forever.
When do we know? I mean, it's just data. Yeah, it's, I guess, data points, right? Or does it really depend on U.S.-China trade?
I think it does to a very large degree. So we probably need to see the shape of deal, the shape of other deals in the region, whether we have a broader sort of like Asia flare-up, and then how far the euro goes in this overshoot.
So interesting. Themos, I really enjoyed that. Thank you so much for coming on.
Thank you very much, Francine.
Themos Fiotakis there, Global Head of FX Strategy and Emerging Markets Macro Strategy at Barclays. Coming up, we talk tech, VC investing, and the race to achieve artificial general intelligence. That'll be coming up next. We speak to Mattias Ljungman of course, Moonfire. We'll ask on defense. We'll talk about the EU AI Act. What needs to be done more to help some of the small startups, but also venture capitalist money coming into some of the sectors. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. U.S. Commerce Secretary Howard Lutnick tells Bloomberg a trade agreement has been signed with China with imminent plans for another 10 major trading partners. The U.S. says it will drop its Section 899 revenge tax threats on foreign investments after reaching a deal with G7 allies. And Nike surges pre-market as a sportswear brand says its year-long sales decline is finally starting to ease. Now let's also turn to the world of tech. The AI race shows no signs of slowing down, with the pace of innovation continuing to accelerate and valuations continuing to climb. So who the winners and losers will be, though, is a key question for investors. Well, I could not be more happy to be joined by Mattias Ljungman, founder and managing partner of VC firm Moonfire Ventures. Mattias, thank you so much for joining us. I mean, there's a million questions on AI because it's difficult to make sure that you don't fall into the hype, and that you figure out who's the good AI and the bad AI. So how do you do it?
Well, I mean, ultimately AI is changing software across the board. Ultimately we are looking to build the next generational company that's taking advantage of this incredible opportunity. You know, we're building intelligence throughout our software. And so we're having a massive step change. You know, we're having what I call just a whole new generation of software that's being built that's going to probably replace most of the existing software that we have out there today. And there's a whole new way of building companies as well that's coming into play. And I would say, you know, the company building that we're seeing today is kind of as big of a change that we've seen since the start of the internet. So today, you can be a 10-person company and build $100 million business. And that was kind of like a fantasy before. But now we're seeing that as a clear trend, a capability where you don't need hundreds of people and you don't need millions of dollars. But what you do need is capability, ability to utilize AI in the most effective manner, and create the next generation of companies.
Mattias, when you look at the EU AI Act, I know there's a lot of people saying that this inhibits startups. Do you agree with that?
I mean, I would say in general, I feel for politicians as well. They're looking to try to find solutions and protect customers and the population out there. But I think we have to be really careful of having a kind of alarmist approach where we have blanket decisions, where we are trying to solve all the problems today. We don't know where AI is going to go. It's going to be an iterative approach. And, the pace that we have actually had change within AI and what we're able to do today is already significant. But we haven't seen a fundamental change in our society and economy and so on. So I think we should be a little bit careful and take it step by step. And that's what I would say to politicians, think about it in the car industry. It took 40 years to build out safety standards, and we just need to be a little bit pragmatic about the whole approach.
Mattias, can you talk to me a little bit about VC fundraising? It's been hard. Is there now any relief?
You mean for the actual funds raising new capital? Yeah, look, I mean, I think it is really hard. It's been 3 years plus where, people are questioning the sector, and there's been, as you know, a bigger sort of overall shift, right, in terms of people thinking about the, where they're going to be placing their next kind of their bets. But to me, the industry itself still is the cutting edge industry, and it is also, the approach where we're going to have these outside outcomes happens in venture. So you can't look at it as an average or a median. You have to look at it as, are these funds capable of doing things that are extraordinary, just like our companies? So I think if you want to look for extraordinary companies, you need to look at extraordinary funds as well.
Do you think there will be some kind of consolidation amongst VC firms?
That hasn't happened before. I think that's kind of hard. But what is interesting is that there has been a bit of acquisitions, which has surprised me. But I think structurally is not really how it works. I think it's going to be that companies disappear, and then, but at the same time too, there is lots of capital still on the sidelines. And I think venture capitalists are also being more careful. They're not going after just the good companies. They want to go after the outstanding companies. That's the next kind of benchmark that's required.
Because when you look at defense, I mean, this is like the big industry that Europe is, betting on, is talking about. But what, in your views, are the difficulties for startups in this industry?
Yeah, look, I mean, first of all, this could be a really interesting moment for Europe because we have the convergence of, the geopolitical requirements and alignments, but also technology and innovation. And so I think Europe has a really good place to play in here. And to me, I also see a bigger trend in terms of, if you look at the companies we've invested in, where maybe they're not directly defense companies, but they have kind of dual purpose. And so we're investing in companies, for example, creating other forms of AI or frontier robotics, cybersecurity, but at the same time, too, they're being used for defense purposes, even though that wasn't our original intention. But it's exciting to see that happen, where we're building up defense capability at the same time, too, driving innovation. Ultimately, Europe needs to continue to create these mission-critical businesses and then take advantage. The founders, I think, are going to take advantage of the fact that we are a stable, reliable, neutral party that is an alternative, and probably, for those out there that, want to have choose between the U.S. and maybe China, we will be that alternative.
What are you most excited about, actually, at Moonfire? I know there's a lot of uncertainty. It's trade, tariffs, wars. Yeah. There's interest rates. But if we finish on maybe a positive note, what do you expect in the next 12 months?
I think, in general, we are in this unique moment in history where we're having a super cycle, AI super cycle, that's redefining, how companies are being built, and we're having a big step change in capability. If we compare this to the Industrial Revolution, where we pushed the boundaries of what was capable of human labor, now we are doing that with intelligence. And suddenly now we are building intelligence and actually scaling intelligence through AI. And we have never been able to do that before. I'd like to end with Sam Altman talks about how intelligence is the most powerful force in the universe. And now we're able to scale it, which is really exciting.
There's a million questions on, artificial general intelligence, which means different things to different people. Do you worry about humans losing critical thinking?
Look, I think it's always going to be part of human innate requirement to be able to do that. We haven't stopped ourselves from applying that on a day-to-day basis. So, no, I'm not worried about it. I think curiosity is what drives humans, and I think what makes us unique as beings. So, if anything, it's going to leverage it. I think we're going to be able to push the boundaries. It's also democratizing it. There's more people who are going to be engaged in this kind of activity. So I think we're going to be more capable, more productive. So I'm extremely positive about the future.
So interesting. Mattias, thank you so much for joining us today. That was Mattias Ljungman, a founder and managing partner of Moonfire Ventures. Now, the Chinese tech sector has been on a roll since the arrival of DeepSeek in January. The Chinese AI startup stunned the world with a language model that claimed to match or outperform Western rivals at a fraction of the cost. Now, with state backing and massive investments fueling China's AI ecosystem, the country is fostering a new generation of startups in search of the next DeepSeek. Well, Bloomberg's Annabelle Jewelers report.
The number one factor that will define whether the United States or China wins this race is whose technology is most broadly adopted in the rest of the world.
It's not just a matter of building more sophisticated models. Competition between the US and China on AI is expanding to standards, governance, infrastructure, and more.
It's very hard to say how far ahead we are, but I would say not a huge amount of time.
Any lead the US has is eroding fast, despite restrictions on exports of advanced semiconductor technology.
The Chinese competitors have evolved and advanced greatly over the last year, doubling, quadrupling their capabilities every year.
Washington is shifting from a strategy of China containment to international bloc formation and promoting US-led tech ecosystems.
When it comes to the rest of the world, we want American AI stack, starting from the GPUs to the models to everything on top.
Pushing countries to build on such frameworks will not be easy, even with the Biden-era AI diffusion rules scrapped.
The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser-focused on competing to win.
Chinese tech now presents an alternative to dependence on the West, with AI leaders like DeepSeek and Alibaba going open source to build quickly and at scale. That's putting the spotlight on flows of talent and money.
American venture capital funds funding Chinese AI, is that in our national interest?
Like Washington, Beijing wants to shape global norms for the use of AI and sees an opportunity in the global south in particular.
Going forward, China will open its doors still wider to the world.
Yet the choice of US or Chinese AI technology is unlikely to be binary, at least for now. Governments have navigated the twin poles of power for years and will likely keep doing so until an obvious reason emerges to pick a side.
Now to some other tech stories making news. Shares in China's Xiaomi have hit a record after strong initial orders for its new electric SUV. Now the YU7 is billed as the direct competitor to Tesla's Model Y. The company says it received 289,000 orders in just 1 hour. Bloomberg understands that Omid Afshar, a powerful executive at Tesla and one of Elon Musk's closest confidants, has left the company. Now, the latest high-level departure during a volatile period for the electric vehicle maker. News of the exit has circulated internally among some employees in recent days, though the reason for the departure is not immediately clear. And Apple has offered to overhaul its App Store after being given an ultimatum by EU antitrust watchdogs. It's proposing to make it cheaper and less onerous for third-party developers to direct customers away from the Apple ecosystem to make payments elsewhere. Now, Apple was fined 500 million euros in April for alleged violations of the Digital Markets Act, which it says it's planning to appeal. Now, more of our interview with the U.S. Commerce Secretary Howard Lutnick on tariff deals. That's next, and this is Bloomberg. Well, back to our top story. The U.S. says it's finalized the trade truce with China. President Trump has hinted that an agreement with India may follow, but he's warned that Washington will not cut deals with every country.
Well, we just signed with China yesterday, right? Just signed with China. We have everybody. We're not going to make deals with everybody. Some we're just going to send them a letter, say, thank you very much. You're going to pay 25, 35, 45%. That's the easy way to do it. And my people don't want to do it that way.
While U.S. Commerce Secretary Howard Lutnick has told Bloomberg that deals with 10 other major trading partners are imminent. Here's more from our interview.
So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago. President just said it just the other, I don't know, 15 minutes ago. And then he also suggested that we are, of course, at the very close finish line with India. Of course, the way these deals happen is their prime minister and their parliament have to approve it, and the president likes to close these deals himself. I mean, he's the deal maker. He loves to close it. I think we have deal after deal after deal. The president's going to make his calls. He's going to decide exactly the finishing touches on them. And then what we're going to do is we're going to lay out a structure of all the different kinds of tariff arrangements with different countries, right? There are countries with huge deficits. There are countries that are balanced. We're going to set that all up and get that ready for July 9th.
So it sounds to me, Secretary, and correct me if I'm wrong, as I listen to you, that we either get 88 deals announced in the next 2 weeks, or there's going to be action one way or the other by this administration that July 9th will be conclusive. If there's no deal, here's the new reciprocal tariff. Is that right?
Of course. So what we're going to do is we'll announce some deals, but basically the deals we're going to announce are sort of the head of the class, the structural spot in the line, and then all the other countries will fit behind those categories, right? So we're going to do top 10 deals, put them in the right category, and then these other countries will fit behind. So you'll have South American deals and you'll have African deals. You'll have it all structured and set up, and that's the model how you do leadership, and we will put these people in their proper buckets on July 9th. So those who have deals will have deals, and everybody else who's been negotiating with us, they'll get a response from us, and then they'll go into that package, and July 9th will go forward. And as the president said, if people want to come back and negotiate further, they're entitled to, but that tariff rate will be set, and off we'll go.
That's the U.S. Commerce Secretary Howard Lutnick. Now, U.S. stocks again in record territory as optimism grows over rate cuts from the Fed. The Nasdaq closing to another all-time high, with the S&P also eyeing a record. Now, let's bring in Ven Ram, our MLive strategist. Ven, there's so much. First of all, thank you for joining us. But there's so much I want to ask you in terms of Fed expectations. But let's maybe start with outlook for U.S. stocks. Where do you see it going?
Morning, Francine. Thank you for having me. I think that, look, I mean, there is no question that, with stocks going from one high to another high, I think it's a question of time before we get another record close. So the question is where really we go forward from here. I mean, everyone knows that valuations are pricey, but how pricey are they? If you adjust the S&P's earnings for cyclical variations and for inflation, what you see is that investors are paying well over 36 times for each dollar of earnings in the index, adjusted for inflation, of course. To put that in context, it's the most they've been willing to pay for the privilege of owning stocks since the dot-com bubble. So I think that, when inflation-adjusted earnings are this low, especially in relation to real yields on 10-year bonds, I think it has historically been a sign of total anemic total returns over the following decade. And, if you look at the correlations between the two, what it shows is that over the next 10 years, total returns on the S&P will be negative 1.5%. What that means is that, if you strip out all the dividends that investors are going to get between now and the next decade, they are going to face capital losses on their investments. So there's a huge warning from the markets, from the whole market's own history, that this is getting to be like a pack of cards waiting to collapse. Now, the markets have decided that tariffs don't matter, inflation doesn't matter, nor will the impact of tariffs on the economy. This is not a movie that may end well, but let's see how this goes.
So there are also, then, growing expectations of Fed cuts, but it's unclear to me whether this is just because of speculation that there could be some kind of shadow, Fed chair figure that could sway or push Jay Powell.
Absolutely. I think that the markets are fearing that, look, I mean, that Trump may nominate someone as the next Fed chief well before the time is due. And I think that fear has caused the markets to price in 2.5 rate cuts by the end of the year, from to about 2 rate cuts earlier before all the speculations started swirling. Now we get another edition of core PCE this morning, and that is expected to show that a slight acceleration. Now, really, if you look at the data, Francine, what we have seen is that core PCE has averaged around 2.7% this year. That is not, of course, consistent with the target of 2% that the Fed is seeking. So the Fed is going to take its time, and nothing that we have heard from Powell in recent days suggests that he's willing to accelerate the pace of rate cuts. So 2 rate cuts up from here seems about right, especially in the context of an economy that is still solid and the tailwinds are still holding the economy aloft.
Ven, thank you so much. Ven Ram there from our MLive team. I would urge also everyone to go and read Ven's great pieces that we have on the Bloomberg terminal, but also on social media. Now, to some other stories making news today in state-run media, reports that Iran's foreign minister as saying no agreement has been reached on resuming negotiations with the U.S. Now, the statement comes after U.S. President Trump said during the NATO summit at The Hague that the two sides would talk next week. Now, Trump says U.S. strikes on Iran's nuclear facilities had obliterated them, though an early American intelligence assessment says Iran's nuclear program had only been set back by a matter of months. And And Bloomberg has learned that Andrew Cuomo has no plans to drop out of the race to become mayor of New York City ahead of today's deadline, despite losing the Democratic primary. Now, that means his name will appear on the ballot in November as an independent. The former New York City mayor, Michael Bloomberg, the majority owner of the parent company of Bloomberg News, has endorsed and contributed to the Cuomo campaign. Meanwhile, the mayor of New York, Eric Adams, has relaunched his re-election campaign after Cuomo's shock defeat. And the U.S. Federal Reserve releases results from its annual bank stress test today. That's something to look forward to. They come as Wall Street banks and the Trump administration have been pushing for lighter regulation. Our Charlie Wells is here with a preview. Charlie, some people look at the Bezos wedding, others the stress test. What can we expect?
So look, I would be stunned if any of the 22 banks that are subject to these difficult tests fail them. That is not because they are easy. The tests so far this year have looked at a hypothetical scenario where these banks were subject to a severe recession, 10% unemployment, and a drop of about a third in the prices of residential and commercial real estate. Difficult tests, but these banks over the past couple of years have been very successful in passing them. They are well capitalized. It's looking like they're in the same position now. And what that tends to mean probably is that after these test results are announced, they will be in a position to talk about buybacks and dividends, which investors love.
Charlie, how's the Trump administration actually looking to change stress testing?
Well, this is something that investors really thought would kind of come into play a bit earlier, where they thought there would be much more leniency here. They thought that there would be, very rapid buybacks. But what we are seeing is that we now have a new top banking regulator at the Fed. She's been in the position only a few weeks, and she's looking for lighter touch regulation. So that could have impacts on these stress tests.
Charlie, thank you so much. Charlie Wells there with the very latest on some of these stress tests. Now, onto a bit of fashion. Anna Wintour, the longtime editor of Vogue magazine, says the Condé Nast publication is seeking a new head of American editorial content. Now, for more, we're joined by our very own Tiwa Adebayo. Tiwa, I mean, this is a huge, huge deal, actually, in the world of publishing. And Anna Wintour is not stepping away from Vogue entirely. But what might the future of the magazine look like?
Well, Francine, yes, it is a really big deal. To put it in more Bloomberg terms, this is the equivalent of more than 2 Jamie Dimon tenures, so 37 years at the helm of American Vogue. But what it isn't is a retirement. She is, as of 4 years ago, the chief content editor for Condé Nast. She also oversees all of the Vogue editions globally for Condé Nast. So she's very close to that editorial content, and it's likely she'll continue to flourish in that role. This has been positioned as part of a broader set of changes that Condé Nast has made. A crucial one is the removal of that editor-in-chief title. So the person that succeeds Anna Wintour at the helm of American Vogue will not be the editor-in-chief, as she has been for 37 years. They will be the head of editorial content, reporting directly to Anna Wintour. So she's definitely not stepping entirely back from the Vogue brand.
I mean, it's interesting because it also goes to, points to the fact that a lot of these, legacy magazines have had to change the way that they push content out to consumers. What will her legacy be?
Well, her legacy at Vogue in recent memory is one of domination. You think of things like the Met Gala. She changed it from a very niche sort of society event to the cultural behemoth that we see today. Although it's important to remember that at times she's faced some complicated issues. She famously brought on actresses to star at the cover of the Vogue magazines and worked with Harvey Weinstein's team. There's a bit of checkered history to do with how she handled the Black Lives Matter upsurge in 2020. So it's not as glowing as perhaps we might all think. There are some complicated issues in her legacy, but she has certainly changed the face of publishing and the face of magazines, as well as the fashion industry.
Yeah, talking about fashion, I mean, all eyes on Venice. And this is not for the canal, but I think we're just getting, pictures, because some media have gone to town. There's live reporting from this, Jeff Bezos wedding. I mean, anyone who's who is there.
This is the wedding of the summer, and there are so many celebrities showing up. There are big wigs from across the board. This almost feels like a royal wedding, right? It's on that scale. When Oprah shows up, you know that it's on the scale of a royal wedding. But I have a question here, and it's, did it have to be Venice? I love Venice. It's so beautiful. There are so many other Italian cities. Trieste, could they have been a little more original?
Trieste?
Yes.
No, Charlie, it has to be Venice.
All
Come
right.
on, if you have the money.
Bari, be a little more original.
For me, Venice all the way, but I appreciate you're thinking outside the box. We're definitely looking also at some of the protesters because of this Bezos Venice wedding. Charlie Wells and Tiwa Adebayo. Now, next week, of course, we're also live at the ECB Forum in Sintra. This is Bloomberg.